investing in your 30s and why it really matters. I'm Emma Wall. I'm Head of Investment Analysis and Research here at Hargreaves Lansdown. So my team look after equity research, fund research, ESG analysis and strategic asset allocation for all of HL's nearly 2 million clients. I'm also a Financially Fearless ambassador, and Financially Fearless is incredibly important because unfortunately in this country we still have bad money inequality, and taking control of your financial future is incredibly important. It helps you live your life to the fullest, prepare for the future, and enjoy the journey along the way. And Financially Fearless's aim is to empower you to be able to do that for yourselves. And it's not easy out there at the moment. So as we all know, there's been an increase in the cost of living crisis, and it has had consequences for both our short-term and our long-term finances and our financial resilience. And it is so important to know how to best navigate our finances, even in times unlike these when things are going a little easier. It's a tough economic climate out there. And it's a very fluid situation. So trying to keep up with the news and the markets is a difficult thing to do. And so we're hoping for this webinar, we can help kind of ease your journey. The one thing that is consistent as the market is volatile and inflation ebbs and flows is that people's concerns around the cost of living remain. We're all feeling the pinch, and the pressure and the pain points that we have on an individual basis will differ. We are adjoined in that. The cost of living crisis across society is unequal. I'm delighted today to be joined by Jessie, the founder of How I Fund This, a personal finance website dedicated to helping millennials transform their relationship with money. Hello, Jessie.
Hello.
So can you tell us a little bit more about How I Fund This?
Yeah, for sure. So How I Fund This is a personal finance community helping people to transform their relationship with money. So that might be looking at how they view money in terms of their mindset, but also those practical tips in terms of investing, budgeting, and so on, to help people to develop more informed financial decisions and feel more comfortable making those decisions based on their circumstances. Oh no, Emma, you're on mute. We now can't hear you.
Thanks, Jessie. I'm trying to navigate a script because this is a financial webinar, and therefore it's really important that we talk about the caveats when investing, talking to Jessie and doing the slides. So apologies if I'm not totally seamless with this, but we'll do our best.
You're doing very well.
So before we go any further, a little bit of housekeeping to cover off. We have got an hour today, or just under an hour. The presentation will last around 35 to 40 minutes. And then we've got some time for questions at the end when we will be joined by my colleague Ellie, who will help present the questions. So if you can please put any questions that you have throughout the webinar in the Q&A box, and then Ellie will jump on at the end and help with those. I do need to stress that everything we discuss today is purely information and not financial advice. Given the time constraints, it's obviously not exhaustive, but I do hope that what we talk through will enable you to go away and make decisions in a more informed position. The session will be recorded, as I mentioned earlier, and will be distributed via email. We'll also be putting some guides alongside the webinar. So topics that we touch on today, there'll be a bit more detail in the information we provide after the webinar, and some useful links as well for you to do a bit more research and self-learning yourself. So let's take a little look at the agenda for today. Starting with an economic update, we'll begin with the big picture, exploring the causes behind the cost of living crisis and the stark reality many in the nation now face. There will be some light at the end of the tunnel because inflation is falling, and so is the cost of energy. And from here, we'll hone in on your 30s and why now is a great time to think about your finances. And we'll look at some small actionable steps you can take to make the most of your money now and get the most of the benefits available to you. And then Jessie and I will signpost the priorities when it comes to building your financial resilience, which is your financial wall of defense. And then if you're in an unfortunate position enough to have some money left over at the end of the month, we'll look at the world of investing and how to take your first step. So Jessie, without further ado, how have we ended up here? Why is the UK in the depths of a cost of living crisis?
It is due to a combination of different factors. So, for example, following on from COVID, when the cost of goods fell, the world then reopened again, and we saw the demand for goods and services increase, and that played a part in the rise in inflation. And then on top of that, we have the war in Ukraine, which then had a significant impact on the price of oil and gas, which then had an impact on the cost of food that we see in the supermarket these days.
Yeah, you're right. The rising cost of living is having a substantial impact on people's personal finances. It makes pretty scary reading that as many as 9 in 10 adults are reporting their cost of living has increased. That's around 46 million people in the UK. And undoubtedly, this has increased the risk of running up debt. What we're seeing is increased credit and debt reliance fueled by the cost of living crisis. So 1 in 8 people are now borrowing to meet their daily essential needs. And households have been in the trenches now for 2 years or longer. First, we had the pandemic, and then the cost of living crisis fueled by the factors that Jessie explained. So Jessie, why is it so important that we all try and live within our means, and even more so now as life gets more expensive?
I think when we live beyond our means, we're more likely to get into debt. And I think that's even easier to get into when the cost of bills is very high at the moment. And again, with those food prices, the cost of living is very high, as we all know. And then if your debt has a high interest rate, that is not going to help the situation. You might end up being, through no fault of your own, in a vicious cycle of trying to pay back that debt, but also trying to deal with those rising costs of living. So living within your means will really help you to actually get peace of mind in terms of that control element of your finances, and trying to not be in this cycle as such.
Thanks, Jessie. And now to the title of this event, Investing in Your 30s. It's a milestone birthday, and it's often a decade which brings a lot of change, which is why we wanted to focus on kind of what investing and saving in your 30s means. From a personal point of view, I am 38, so I have got most of the decade, if not all of it, done yet. And it has been a very formative 8 years for me. So everybody's life choices are different, but for me, my 30s has included getting married, changing jobs, becoming a mother, emigrating to Hong Kong, migrating back to the UK, moving cities, and then of course what we've all been through, so the pandemic, and then in my job along the way, some very challenging markets as well. I'd say my 30s has been the decade where I've had to become less selfish about my finances. So although my salary has increased over that period, my disposable income, because my dependents have increased, has not kept in line with that increase. And also it's a time which I'll be honest, I'm a geek. You can see what my job title is. I've always thought about the future, but becoming a mother makes you think even more about kind of costs that are coming down the line. Jessie, you have already written on your website about the money lessons that you have learned in your 20s, but perhaps you'd like to share with our audience what they were and how that has changed your mindset coming into this next decade.
Absolutely. So I started my 20s with a very anxious relationship with money. I dreaded looking at my bank account or applying for standard financial products. And I was very much a bury my head in the sand person when it came to my finances. But I realized that actually it didn't have to be that way. I didn't have to feel that way, and I didn't have to have that relationship with my money if I didn't want to. So I really took the time in my 20s to build my financial literacy and try and improve that so that I could then in turn improve my relationship with it. As I come into my 30s, I'm now 32, I feel so much more confident in making those financial decisions for myself. I am a solo household, so all of the decisions are mine, which is empowering, but also can feel very overwhelming. But having that financial knowledge and that education behind me really helps me to and I keep saying the word confident, but it does make me feel more confident to make those decisions going forward. And hopefully the rest of my 30s will help me as well.
And hopefully be a lot of fun along the way.
Yes, hopefully.
So the clue is in the title. Obviously, we are talking about investing in your 30s, but it's important to cover off a few things before we get started. So this is step one of investing, and it's ensuring that you're in a place to do so. So the first one is very important, and that is controlling your debt. It's inevitable that we'll all be in debt at some point in our lives, and not all debt is bad. It's a necessity for the majority of us when looking to buy a property or to attend university, both of which can be seen as an investment in our futures or in our families. But what is important is that you manage it properly and it doesn't spiral, as it can be a real threat to your financial future, as Jessie has outlined earlier. So keep an eye on your personal debt. And if you feel that it needs addressing, look at that before you start investing. It's really important to shore up your financial resilience before you take that next step. And now to the second point, which isn't completely unrelated to the first one, but it's about protection. And why is that paramount to building financial resilience, Jessie?
Life is full of curveballs. I think we've all realised that over the last few years. But having that right protection in place helps us to have that peace of mind, should anything happen where we might need it.
And number three is saving a penny for a rainy day, which is such an oft-used euphemism. And rainy day is hardly just the right descriptor, because when you need money for emergencies, it's bigger than rain that you have to worry about. But I'm sure it's something we can all be remembered being told time and time again. But it is very important, particularly in the current climate, because it is impossible at the moment to predict when things might go wrong. So if you look at the examples of kind of holiday or flight cancellations a couple of years ago, and not having that kind of buffer through to thousands of people needing availability of cash because they might have been put on furlough or lost their job during the pandemic. So an emergency rainy day pot is really important, and make sure that you've got that in the bank before you start investing. And we recommend around 3 to 6 months salary or expenditure before you start. And Jessie, what is the next step?
The next step, yes. Oh gosh, sorry, it's making your money work harder for you, and we can do that by putting your emergency fund in an easy access account and with a good interest rate. And you can that can help you to earn interest on top of what you're setting aside already. So that's a really good way to, make it work harder for you.
Absolutely. Don't just keep that rainy day in the bank. Go out there and make it work hard for you. And the final step before you're ready to leap into investing is ensuring that you are planning for later life. So once you've built up your short-term emergency fund and your short-term financial resilience, think about the long term, and that's when pension planning comes in. So now for many of us, this may be taking advantage of a workplace pension, or if you're self-employed, setting up a SIPP. But make sure you are building that retirement pot for the long term. And we have calculators on the HL website if you want to check whether you're on track. So a few tips you can start thinking about implementing. Start early and pay as much as you can afford. Where possible, keep up your contributions into your pension. So, for example, if you have a career gap, think about whether you're able to continue to make those monthly payments or even lump sum payments. Make the most of employer contributions. This one's really important. It's very, very rare in life you get what is really free money. But if you are lucky enough to be employed somewhere where they offer pension contribution matching, take advantage of it if you can. And think about increasing your contributions as you get salary increases. And then once you've got all those steps in place and you're comfortable with your circumstances, it's time to make your money work harder for you. And by that, we mean investing. And please keep in mind that investments can go up and down in value, and you could get back less than you invested. So there's a couple of different ways to go down the building a pot for a later date. And it's the saving versus investing route. Of course, you can keep it in cash, hopefully in an account that's working hard for you rather than just in your current account, or you can start investing. So Jessie, when is the right time to opt for cash savings?
Cash savings are great if you're saving for your short-term future. So this could be a 6-month break from work, a honeymoon, some house renovations that you might have on your horizon. And you'll also want to make sure that your emergency fund is easy to access as well. and that should be in cash.
And the flip of that is investing. And that's when you take your cash and put it somewhere ultimately that it will hopefully grow over the long term. It's really important to consider investing as a long-term endeavor. As Jessie said, this is not about short-term financial goals or even about your rainy day pot that you need to rely on being there and easily accessible. But investing is sort of for 5 years plus. So absolutely when you're saving for your retirement, for your pension, or for kind of longer term financial goals. So investing can be good if you're looking to generate an income or for growth. By this, we mean that companies will pay you dividends if you're a shareholder, more of that later. And by growth, that we mean that the overall pot of money gets bigger over time. And there's a much better chance of beating inflation by investing in the stock market than in cash, which is obviously something that's on top of people's mind at the moment. But your investments can fluctuate, so returns aren't guaranteed. So to put some things into perspective, this is calling out the difference between cash and investing over time. So as you can see, this goes back 30 years, quite a long time. The grey line is the global stock market over that time. So if you'd invested in 1993, your returns since then would be 950%, compared to just 37% of your average instant access cash account. Now, 30 years might seem like a really long investment horizon, given the title of this webinar. It's basically how long everyone's been alive so far. But over 30 years is really your retirement savings. I mean, that is the outlook for how much longer you may be in work. So it just calls into kind of reality the importance of putting your money to work over that time. And the darker orange line is an instant access cash account. Of course, past performance isn't a guide to what might happen in future, but is it indicative of kind of the different performance that you might expect for investing versus cash? And the yellow line, sorry, I should have said, is the consumer price index, which is inflation. So as you can see, the yellow line is above the orange line, indicating that cash has not beaten inflation, whereas the other two lines are investment examples. So your money would actually have lost its buying power in cash because it hasn't been able to keep up with inflation. So we saw the impact of inflation there. We've talked about how investing has the potential to beat inflation. And of course, inflation is in the headlines a lot. So Jessie, I don't know if you want to quickly explain what is inflation and how it impacts the value of cash.
Yep, sure. Inflation is a term that we use to describe the price of or prices increasing over a given period of time. So if inflation increases those costs of goods, then you won't be able to buy as much with your cash as you may have been able to do previously. This means that the value of your cash has decreased.
Yeah, I always think about the fact, curly whirlies. Anyone remember curly whirlies? Used to be like 12p and now they're like 35. That's inflation in real life. Or the fact that Pizza Express pizzas are so much smaller and yet more expensive.
Yeah.
Shrinkflation. So with the combination of those recent slides, it really is your best friend investing. I always say the best time to invest was yesterday, regardless of what the market was doing. So, but if you can't manage yesterday, then do it today. So time is your very best friend when it comes to investing. And hear me out, I'll tell you why. The average round of drinks these days is £30. Laura put these slides together and I'd like to know when Laura is buying this round, because I took my team for a round in Brewdog last night and it wasn't £30. And some of you on this call, so I'm just saying it was more than £30, but let's use it as an indicative. So £30 if you're lucky. That's one round of drinks invested every single month. Left in an ISA, which is a tax efficient way of investing, more of that later, and left to grow at 5% a year for 30 years, that would turn into more than £24,000. Of course, returns aren't guaranteed, but it's pretty compelling. So if you can invest monthly, you don't have to invest big sums to really build up that pot. And I think it's a really powerful message. A lot of people think that investing is just for people who are affluent, who have lots of money to spare a month, but £20 is manageable, hopefully for many people. And you can invest for £25 a month on our platform and others. So if you're able to up that to £200 a month, then that figure over the period becomes £160,000. And that is £90,000 more than if you'd left it in cash. And this is because of the power of compounding. Jessie, do you want to explain what compounding is?
Of course. Compounding is when you make a return on the original investment you made, but also any previous returns you've made as well.
Thank you. And now, I love the title of this. Laura should get the credit for this, but girls just want to have funds. Funds are one of the options that you have when investing. What are they and how they work? So funds are a collective investment. And what do we mean by that? It means that investors' money is pooled together. So I might put £100 in, Jessie might put £100 in, and that money is pooled together. And then that money is invested on our behalf. And where that money is invested is dependent on the objective of that fund. So, for example, you might have a UK equities fund, which will invest in UK companies, or an emerging markets fund, which will invest in companies across emerging markets. Or you might have a fixed income fund, which will invest in lots of bonds. But ultimately, it's a collective investment. So our money is pulled together and invested on our behalf. And you can find funds that offer exposure to lots of different geographies and lots of different asset classes. So shares, property, bonds, as well as some investing in cash and gold. The main thing that sets funds apart from shares or equities is the fact that our money is kind of pooled together and you're invested in multiple different companies, different types of asset class within that fund. So your money is spread around and you do get that instant diversification. And diversification is one of the things that we bang on about with investing. Why is diversification so important? What is it, Jessie?
It's essentially not putting all of your eggs in one basket. So it's spreading your...
I always think of Love Island with this phrase. It's all about Love Island.
Yes, for sure. But it's spreading your investments across different regions, assets and industries. And having a diverse or varied portfolio means that you can reduce the amount of risk within that portfolio. So if one investment isn't doing so well, then you can potentially offset that with another investment that is doing well.
Thank you. Another thing to bear in mind with investing in funds, as well as the different geographies and asset classes that you can choose from, you can choose whether to invest in an active or passive fund. Now, these different types of funds will offer the same exposure in terms of those geographies and asset classes, but the way that they do that will be different. So in the case of actively managed funds, there is an individual or team of individuals, unfortunately still predominantly men, but it is getting better, who will choose which of those investments within an investable universe that they think is the best one for you. Whereas a passive fund will buy every single one of those available companies. So, for example, in the UK, a UK equity fund manager might choose to invest in the 30 companies in the UK that they think offer the best opportunity for growth, although nothing is guaranteed. Whereas a passive fund will invest in every single one of the FTSE 100 companies, for example. So with that in mind, is active worth paying for? There are plenty of examples of active outperformance, but you can see that it's not a given. So with this in mind, I'd say it's important to do your research, and we have that research available on HL as well, to help you sort the wheat from the chaff. No guarantees, but a good active manager will outperform an index. A bad actively run fund will not. Now moving on to equities. We looked at funds, and it's time to now look at what a share or equity is. Jessie, what is a share or equity?
A share is essentially a slice of a company. So let's say that you, let's use an example such as Tesco. You can buy shares in Tesco, and then you could essentially own a little bit of Tesco. You can use those shares to then trade those on the stock market. And that's why we see prices increase and decrease throughout the course of the day. It's governed by supply and demand, and while the markets are open. So yeah.
And a company that you can invest in is means that it's gone public, doesn't it? So that means that it's gone public through something called an IPO, or initial public offering. And there's a difference between investable companies on the stock exchange, which are public companies, and private companies. The reasons why companies go public broadly are because they need to raise cash. So if you think about, you might start a startup yourself, you might start by borrowing money from family, then goes to banks. But ultimately, if you want to scale, you'll need to have access to financing. And so that's when people decide to take their companies public, so they can access the public market and have individual investors, such as Jessie or myself, or those of you on the call, help fund their growth through investing in their shares. So in terms of how shares work, the value of a share can go up and down in a day, but it's the longer term trajectory that you need to consider. We're absolutely not just saying, suggesting that you should become a day trader. That's not how good, sensible investing works. You should be looking for stocks that you believe have a long-term investment potential, whether that is growth or income. The stock market obviously goes up and down, and that's because the individual companies within the stock market change their value due to a number of different factors, but it's that long-term view that you should be focused on if you're looking to invest in equities. So some shares or equities will pay a dividend to their shareholders, and a dividend is essentially a payment to the shareholders from a company when the company has excess cash to do so. It's one of the core benefits of owning shares, and then you could of course profit if the value of those shares increase over time. It's also important to think about the total return benefits of dividends. So just because you don't want the income now doesn't mean you can't then reinvest that in order to maximize your growth potential. There are more than 58,000 companies listed on the stock exchange in the world. So it's understandable that for some people, in fact, most people, and even me as a professional, that can be overwhelming. So how do you make it work for you? Well, Jessie is going to talk us through some golden rules when it comes to investing. It is worth noting, however, that most people, us included, should be in funds, not stocks. And that's because it helps to reduce risk and it gives you that instant diversification that we talked about earlier. So shares are attractive for a number of reasons, but they do come with higher risk and do require quite a bit of engagement, by which we mean time and money. So Jessie, over to you.
With those golden rules. Yes. I would say learning about investing, but also making sure that the risk doesn't always mean higher rewards, and actually understanding what that means can really help you. Also reviewing your finances before you start is very important. And don't make rash decisions. As Emma said, things go up and down, but look at that over the longer period of time. And as we've mentioned as well, diversifying your portfolio to try and eliminate or reduce that risk, and also reviewing your portfolio periodically to make sure it's still working for you and what you want to achieve. And then also be mindful of any fees and tax that might be required to think about as well, such as ISA tax allowances and so on.
Thanks, Jessie. Those are the core considerations when it comes to investing. Now, what to look for when it comes to investing. You are looking for financially resilient companies with a proven track record. And how do you ascertain whether a company has those characteristics? Well, one way you can do that is by looking at the annual report, so which this outlines their strategy, financial performance, threats and opportunities. Now, before you think this is going to be chock full of jargon, the point of the annual report is for people like us, and that is non-professionals. So it's written in a way that should be understandable and often comes with a CEO or strategy statement to help you make sense of the numbers as well. So it is really important to understand what a company does and what its market position is. It'll also have information about kind of previous years, so you can see whether things like profit and revenue has increased over time or whether indeed it's going down. And for those of you who don't want to do it all by yourself, I know this sounds like a plug for my team, they are brilliant, but my team does provide research and insights for free on over 100 UK and international shares. And you can sign up to the newsletter for free as well, so you can get that coming into your inbox, which will hopefully help guide you and inform you to better investment decisions. So I'd recommend doing that alongside your own research. And there's a QR code if you'd like more information, and we'll be provided that in the web after the webinar as well. Ellie's going to send around some helpful links. So you're thinking that you might be ready to take that first step and invest in funds or shares, maybe a bit of both. where to do that. It's important to consider the most tax efficient ways to invest. And the most tax efficient way to invest is ISAs. They're a sensible first option. So the one hand, you have your stocks and shares ISA. The name is a bit of a misnomer. You can invest in funds, really. Really, it's just an investing ISA. On the other hand, you have a cash ISA. So bear in mind that the maximum allowance every tax year is £20,000. We've got the autumn statement coming up next month, where you may see changes to that, but currently your tax allowance, your ISA allowance, is £20,000, and that's across all ISAs, so both the stocks and shares and cash ISA. And you've got tax-free growth and income in an ISA, so there is that huge benefit there. And stocks and shares ISA, you can choose your investments within the tax-efficient wrapper, and you can access your money at any time. And as we've stated before, investing should be considered for the long term. On the flip side, you might need your money sooner than that, and that's fine. So that's where a cash ISA comes in, which may be a more sensible approach for you if you're not quite ready to take step to invest. And within a cash ISA, as you're probably familiar, you have an easy access ISA, you can have fixed term ISAs, or you could have limited access ISAs. So make sure you read the small print. And then we have something else in the mix. We have the lifetime ISA. Jessie, can you talk through what our audience might consider using this account for, and what are the rules that come with it?
Yep, sure. So a lifetime ISA could be used for either buying your first home or from the age of 60 for something such as retirement. So if you're getting on the property ladder, it is important, and if that's something that's important to you, then putting that into your long-term savings, this might be something that you want to consider. You do need to be between the ages of 18 to 39 to open a lifetime ISA, and you can pay in up to £4,000 per tax year until your 50th birthday. The government would then give you a 25% bonus on top of that each tax year. And if you are buying a home, then the property needs to be within the UK. It needs to be £450,000 or less, and it needs to be bought using a mortgage, and it needs to be your main home as well. It's worth noting that there are both stocks and shares and a cash version of the ISA. And if you do want to use the money for anything other than your first home or before the age of 60, then you will be subjected to a 25% government charge. So this means that you could get back less than what you put in.
Thanks, Jessie. Really important information. That brings the session to a close. Please do pop your questions into the Q&A, and Ellie will help us navigate those shortly. This is a final slide from our compliance team. Please take a couple of minutes to read through the important investment notes. They reiterate that this session was purely informational and not to be construed as financial advice, and that stock market investments can decrease as well as increase in value, and the tax rules are subject to change, maybe even as soon as next month, depending on what happens in the autumn statement. Great. So now I'm going to pass over to Ellie. Firstly, I'm going to say thank you very much to Jessie for being our guest. Thanks, Jessie. Please stick around to help us with the Q&A. And Ellie, over to you.
Thanks, Emma. I think we can all agree that was an amazing session. Thank you so much, guys. I really enjoyed that. So we've had a few questions over email, and we've also had a few questions in the chat. So I'll just start running through them. So first question, is there a recommended cash or investment ratio, or how do you split your money between cash and investments? Maybe for you, Emma?
Yeah, so the first thing I'd say is it's different for everybody. And this is not financial advice, but the guidance would suggest that for short-term goals and for a rainy day fund, that's where cash comes in. So really thinking about 6 months expenditure or 3 months salary, building up the cash. For anything longer term than that, particularly for retirement, the data shows, as you saw from that graph, that cash just does not help you achieve your long-term financial goals. The inflation drag on cash and the asset allocate, I mean, could get really techie. The capital market assumptions for cash suggest that you're just not going to hit your financial goals for as long. So I'd really, rather than thinking about it proportionally in a portfolio, I'd think about it in a goals way. So cash for a rainy day and for short term, and investing for long term.
Brilliant. Thank you so much, Emma. That's great. Next question. Somebody's got quite an interesting question, actually. I don't find investing interesting, but does that matter? And how do I make that more interesting? Quite a controversial one considering the topic of the webinar, but I'll hand that one over to Jessie.
It is interesting. What I would say is I found that learning about something or finding that source of education, whether it's a podcast, whatever it is that interests you, can really help you to actually feel more interested in investing. Hopefully that's how I found it from my personal experience anyway. The more I've learned about it, the more interested I've become in it, because it is vast and it is varied, which I'm going to be honest, can feel quite overwhelming. But trying to, I guess, cherry pick those things that you're already interested in from sources that you find very helpful is a really good place to start.
I might just add to that though, because I would say actually that whoever asked that question, you may end up being the best investor out of all of us, because tell you why, it's actually been proven that inertia, or not giving a fig, is one of the most powerful ways of building your investment pot. So there is a report from Morningstar called Mind the Gap, which actually shows that the biggest attractor of returns is often investors being far too active. So, we see the market fall and we think, oh God, and we sell something. And actually the best thing to do in those situations, often, caveat emptor, not all the time, but often the best thing to do is completely ignore it. So whoever asked that question, you may end up being the best investor of all of us. All you need to do is take that first leap and outsource the kind of asset allocation, get yourself a kind of well-diversified single one-stop shop fund, and we can provide some information on kind of what I mean by that after this webinar, and then just set and forget. And yeah, you could end up laughing at the end in multi-decades as Jessie and I tinker too much.
Love that. Thanks, guys. We've got another question in the chat. So how do you know when to cut your losses on investments? Emma, what do you think on that one?
First thing I say is really difficult. Even the professionals get it wrong. Often the professionals get it wrong. But one good place to start is to clearly identify what your own financial goals are. And if you are more engaged and have the time and inclination and want to do stock selection, write down the reasons why you invested in that stock in the first place. And then on an annual basis, review the investment against your thesis. So if you invested in it because you wanted dividend growth and that company no longer pays a dividend, then you can check your investment thesis against the company. If you're investing more for a goal, then I'd say there's guidance on our website on kind of what a balanced portfolio should look like. It's about rebalancing. So, for example, quite a lot of investors at the moment, because despite the volatility over the last 5 to 10 years, there's been quite a small section of the market that's driven returns, and that is the US and tech stocks. So if you've ignored your portfolio, you might find that it's tilting in a particular way. And so on an annual basis, it's quite good to have a look at your portfolio and check again, either do the investment thesis holds true, and is the portfolio in the same shape as you initially started and initially you wanted. And that's a good way to kind of nudge and hopefully not overtrade, because as I've mentioned before, tinkering can often be your worst enemy.
Brilliant. Thank you very much, Emma. I got another one in the chat. So somebody has recently set up a junior stocks and shares ISA, and they want to kind of, regarding compounding, what's kind of the best investment to make? How do you go about choosing investments? Obviously, we can't give individual fund recommendations because that's advice, but how would you kind of go about picking those investments? I'll hand that back over to Emma again, that one.
So, we can't give individual advice. I'd say it does rather depend on circumstances. You say you opened a JISA, but I don't know whether you've opened a JISA for somebody who's just born or somebody who is 15. What I would say is we have got a JISA guide on our website, which includes some fund ideas. So maybe, Ellie, we could include the JISA guide in the materials we send around to all attendees afterwards.
Yep, I've noted that down, so we'll send that out after. Next question. So somebody's looking at our website right now and they want to know what's the difference between investing in an ISA versus, say, a fund and share account. Jessie, are you okay to answer that one? Oh no, I'll pass over to Emma then.
Tax benefits is the main one. So ISA is, as we've mentioned on the webinar, comes with tax benefits. And a fund and share account is for those people, I would say, who've already maxed out their ISA allowance and still want to invest. But fund and share account, you will be liable to tax on gains and income. So I would always use the tax efficient options first.
Awesome, thank you very much. And then somebody's asked, if I'm in my late 30s, is it too late to make a difference to my pension contributions? And Jessie, I'll hand that one over to you.
It's definitely not too late. As Emma alluded earlier, yes, we should have started yesterday, but now is the perfect time to start. If we couldn't do it yesterday, do it now. You're not too late. That's what I'm put to say. You're not too late.
Brilliant, thank you very much. And then I've got a question on, can I transfer a Help to Buy ISA into a lifetime ISA? Emma, I'll hand that one over to you.
I believe so, but they have slightly different structures and benefits. So again, perhaps that's one we could pick up after the fact. Jessie, you might be more informed on that than I am.
I think there are certain considerations that we need to take into place. I'm going to be honest, I can't think of those off the top of my head right now. I'm really sorry.
The capital is your own, but because the benefits are different, there is small print. So we'll circulate something afterwards.
Yeah, I think we've got an article on that on the website, so I'll circulate that after the session as well. I've got another question here. Should I have a self-invest pension if I have a workplace pension? Emma, I'll hand that one over to you.
Obviously, everybody's individual circumstances are different. What I would say is if you have got spare money to be putting aside every month and your employer contribution matches, the workplace pension ends up being a more powerful financial tool for your future, because you've got your contribution, your employer's contribution, and then the tax benefits on top. So you're maximizing the power of your money and maximizing your potential income in retirement. For those people who are self-employed, who obviously don't have the benefit of employer workplace pension, then absolutely SIP and a lifetime ISA are two really important tools to kind of make your money go further for retirement. But if you've got an employer who matches contributions, for me, that's always the first place I'd go, because you can maximize your pot.
Brilliant, thank you very much. I've got a couple of questions in the chat. I think Catherine, your one might be a little bit, I don't think we will be able to answer that in this webinar, but Dan is asking about fees. So he's just wanting to start investing, but the fees are shocking him a little bit. Is there any kind of an explanation on fees, investment fees, the different kind of accounts you can get? Emma, I'll pass that over to you.
So I wouldn't. I noticed that you call out a particular provider, so I won't be able to comment on that particular provider because it's not us. I would say shop around like anything, right? So if you're looking for financial advice and you are fee conscious, I wouldn't be put off by one provider, because actually there are times in life where an advice is really useful. Starting out, major life events, starting a family, buying a house, sadly the loss of a family member that may lead to inheritance, big lifetime events. Often it can be great to get some help with that, professional help in the form of advice, but different advisors charge different fees. So I'd encourage you to shop around, and then if you decide actually that professional advice is not for you, take advantage of free guides and research from reputable providers before making any financial decisions. But yeah, don't be put off by one provider, because if you need advice, then it's important to get that professional guidance.
Cool, thank you very much. It's a very great comment. Okay, we've got another question from Dan as well. If the government look at fractional shares, will it be best to move more into funds? That's probably bridging on advice. Emma, I'm not sure if you've got a comment on that one.
It's a live debate, so that I know it's something that has attracted quite a lot of press attention, and I do know that the regulator and the government are looking into it. So obviously I don't work for either, so I can't comment on the trajectory, but it's definitely a live debate, so I would keep on top of it.
Brilliant, thank you very much. I don't have any more questions in the chat, and we've been through all the email questions as well, so if nobody else has any questions, we'll wrap up now. But yeah, again, thank you so much, Emma, and thank you so much, Jessie, for the brilliant session. I'm sure we've all learned a lot, and yeah, ready to take the first step now, I think. But yeah, thank you. Have you guys got anything else to say?
No, just thank you so much for the opportunity. Sorry, Jessie.
I was going to say the same thing. Thank you very much, and thank you to everybody who attended as well. Thank you.
Awesome. Thank you, everyone.
Cheers, and take care, everyone. Bye-bye.